All right. All right. So first off, I want to thank you for joining us, Steve. And you got Michelle's name on there, but
Oh yeah, I do.
yeah. But I want to thank you for joining us. I'm super excited to just constantly be bringing people to webinars to educate them on essentially what's possible in the world of dentistry, in the world of business. And I got to know Steve here about, I want to say it was coming on 2 years in July is when I think one of our first interactions was at the dental festival in Nashville.
Yep.
And I can honestly say I have been blown away from all of the knowledge and tax shortcuts, tax breaks, and financial gain that I've been able to get from Steve since we've been working together. Steve is my personal CPA for my businesses and works specifically in the dental industry with dental practices and dental professionals, and he knows his stuff better than anybody. And so I figured I would bring him on here and teach you how to get a discount on a tropical vacation, we'll call it.
Yep.
And I don't know how some of you have got here. Some may have came through Smiles at Sea or the Dental Festival. This is not a webinar about Dental Festival or Smiles at Sea. However, it is a webinar to teach you how to make it to where that's paid for from other tax strategies, or pieces of it are paid for through some of the things that he's going to be delivering to us tonight. So we're going to have some time at the end to open it up for questions, but I will go ahead and turn it over to you, Steve, and let you share your slides, and then I will close at the end as well if there is no questions. So, Steve, I'm going to turn it over to you, my friend. Thank you so much again for joining us.
Okay, sounds good. Let me get my slides started here. You guys seeing this?
Yes.
Yes.
All right, sounds good.
Yep.
All right, well, thank you, Elijah. I appreciate you for having me on here and to talk about something fun, cruises and Smiles at Sea events, and a chance for me to nerd out about taxes. So I'm going to be talking about how you can get some tax benefits from a Smiles at Sea event and things like that, and also the pitfalls or things that you need to be aware of to make sure that you're above board and you're doing things correctly. So with that, I want to just take a minute and introduce myself. So I'm married. I have 4 children. I live in Utah. This picture is a couple years old. Our baby there is now 2. Our kids keep getting older every year for some odd reason. And I love working with dentists. We're not exclusively dental, but we work with a lot of dentists, and we have our main focus in that area. I've been with Drill Down Solution for 10 years now, and it was previously under the name Lunsford Peck, named after Weston Lunsford, Shaylin Peck, the founders of Dental Intel. And I've really enjoyed my time. Before that, I was an auditor for the state of Utah in corporate tax. So I have a little bit of a background on the dark side and what auditors may be looking for. My dad was also an IRS agent, and I don't tell everyone that, but I do have a little bit of insight there with that background. So let's talk a little bit about audits. We know that audits are going up, and the IRS has funding for it. They're hiring. It's going to be a process before they're hired to capacity, but there are going to be more audits. So your risk of being audited is more than it has been at any time in the last 10 years. They're specifically going to be focusing on high income taxpayers and partnerships. If your income is less than 400,000 annually, then your risk is still low, but for everyone else, your risk is going up. And if you're consistently making $1 million or more, plan on an audit no matter what, even if your things are clean. So, and with that, with an audit, there's some things that you want to be prepared for. Keep receipts, number one. Nowadays, they can be digital, they can be electronic, or you can store hard copies of receipts, and that's fine. I had a client years ago. We had a client in our firm. She was not a dentist, but a self-employed person. And she, before she got pulled for audit, she had kept receipts, and she kept them in her house, physical receipts, and she had a break-in in her house. And all her financial records, including her business receipts, got stolen. And we showed the IRS articles, an article of the break-in, and I think we had some court documentation verifying it. The IRS didn't care. They didn't have their receipts in front of them, and they disallowed her business deductions. Now, I think we ended up getting that worked out through the appeals process, but it was messy. And she didn't do anything wrong, but that just goes to show you the importance of keeping receipts. And the next word of caution is have clean bookkeeping. If you've got things in the wrong category, or if you've got a bunch of personal stuff mixed in with your expenses, that just makes, first of all, it can delay the process. An IRS audit is not a quick thing. They're not looking at one or two things and getting out of there in 2 months. It typically takes more than a year. So if you haven't been audited, it's not fun. Your CPA can represent you and take away the legwork, but it is a lot of runaround and a lot of stress while you're waiting for something to be finalized. And the cleaner you keep things, the more likely it is for the IRS to determine that, yeah, I can trust your financial records. We've heard of stories where the IRS has seen a lot of personal stuff mixed in with business deductions in their P&L and so forth, and just they can disallow all your business expenses because it's messy, and they can't trust that what you're claiming as business expenses is actually a business expense. So have everything clean. Have someone with experience in bookkeeping and accounting doing your bookkeeping, and everything needs to be justifiable. So when we save our clients money in taxes, it's through tax planning. It's not from fudging the numbers after the fact. It's from looking at strategies ahead of time so that you can make sure things are legit. Having a reasonable compensation if you're an S corp is the low-hanging fruit for the IRS. So you want to make sure your compensation is reasonable. It kind of depends on what kind of income you have flowing through your S corp. But if you're high income, about 170,000 is probably what you should be pushing toward for a reasonable compensation. And again, tax planning before the end of the year. So now that we got that stuff out of the way, let's talk about how to get a deduction for a cruise or a Smiles at Sea event or something similar like that. Let's talk about, first of all, what does the tax code allow for business expenses? The tax code specifically allows anything that's ordinary and necessary for your business. So it's important to note that both those words have to be there. It has to be an ordinary business expense, and it has to be a necessary business expense. Now, ordinary means that it's something normal in your line of business. If you're a dentist, going to a CE course is normal. Going on a cruise could be questionable, but where Smiles at Sea has been doing this for several years, a lot of dentists have gone to events like this. You're not going to be the first one trying something like this. I would say that's an ordinary business expense for your line of business. And necessary doesn't mean that it has to be absolutely necessary, but it has to have some kind of business purpose, meaning you're doing this you're incurring the expense to incur a profit from that expense, if that makes sense. So ordinary expenses. Now, what you'll learn is that everything in the tax code, or a lot of things in the tax code, have an exception, and then there's a lot of times an exception to that exception. And there are some expenses, even though they are business related, they are specifically disallowed by the tax code. First of all, entertainment. Entertainment is not allowed, even if it's a business expense. And meals are allowed at 50%. So let's talk about entertainment, because that's going to be a hot item when we're talking about a cruise that involves entertainment. There are some exceptions to the exception that entertainment is disallowed, meaning some entertainment is allowed. First of all, food and beverage furnished on the employer premises primarily for the employees. And the 50% limit still applies. There is some confusion about that one, because a few years ago, food and beverage furnished on the employer premises for employees was allowed at 100%. They have changed the law. It is allowed at 50%. And you might wonder, why is this even spelled out? Because meals are already allowed at 50%. Well, meals in the context, in the general context, are with a customer or someone other than just an employee of the business, but there is an allowance if there are employees. That doesn't tell us a lot about cruises or Smiles at Sea events. Amounts treated as compensation to an employee. So if you wanted to send an employee on a cruise or something like that and tax them on it, that's 100% deductible to you. Employees aren't going to like that, but it may be a trade-off, and it may be something to just be aware of, that could be a bargaining chip with employees, that, hey, I'll send you on a cruise or do something. It doesn't have to be a Smiles at Sea event, but something fun like that, travel that's personal, non-business related, you can deduct it as long as they pick up the tax, and some people might be willing to do that. Reimbursed expenses. So when you're bringing something in as income or as a reduction to your expense, and it's really just a reimbursement, the idea here is that you're not double hit by claiming income and also not being able to take the expense. So you are able to take the expense against something that's being reimbursed to you. Recreational for not highly compensated employees. So a recreational activity, so a cruise could be a recreational activity for not highly compensated employees. So the tax code defines highly compensated employees as 10% or more owners, or employees making 155,000. So most of your doctors and associates are not going to qualify for this exception, but that does mean that provides a specific exception for your staff. If you wanted to send hygienists or other staff members to a Smiles at Sea event, that is 100% deductible, and they don't have to include that as income if they're not highly compensated. Business meetings, again, 50% limit still applies. And expenses related and necessary to attend meetings for tax exempt business leagues. I won't spend a ton of time on that one. Items available for the public. So what we're getting at here is, if you were to host an event for the general public, where you had something at a park and you brought food, hot dogs, whatever, as a publicity, as a marketing strategy to celebrate your dental practice or something of the like, where anyone can come, and you have some food, you have some entertainment, that is 100% deductible. Entertainment sold to customers. So this is where Elijah, who's in the Smiles at Sea business, can fully deduct his costs related to cruises or anything entertainment related. His DJ Smile stuff he does, where he is in the business of providing entertainment. I have a client who he hosts a website that basically is a movie critic website for movies and shows. So he can go to movies and things like that that are related to his business because he's in the business of entertainment. And amounts reported on a 1099 to independent contractors. So if you've got an associate that's 1099 and he's willing to pick up the taxes on a entertainment event, you can deduct that. So now that we know what our options are, let's talk a little bit more about some key takeaways. First of all, CE events are tax deductible if the purpose is to maintain or improve skills, not to qualify for something new. So generally, any CE event is tax deductible. And business travel is tax deductible. Okay. Cruises for non-owner and not highly compensated employees are tax deductible. The only portion here that may not be tax deductible is the cruise portion for the owner, doctor, and most associates. So you send your staff, the cruise itself, and everything else is deductible. For you personally, the cruise portion may not be deductible, but all your travel, the CE event, is all deductible. Now, it's important to note that the IRS does have a rule with entertainment events where if specifically for food, and it's coming from examples where if you were to go to a sports game and you get a package where food is included, unless that cost of food is separately stated or itemized in the invoice, that's all considered entertainment and not deductible. So be aware with that. I recently booked my cruise for the Smiles at Sea event in November, and the cruise is separate from the CE event. So that is great. So again, the CE event itself is entirely deductible no matter what. All your travel is deductible. If you send staff, that's all deductible. The cruise portion for yourself is the only piece that you need to be concerned about. Now, I'm going to shift gears a little bit and talk about the R&D tax credit. There's been a lot of talk of this in the dental world. Some of you on this call may be well versed in it. Maybe you've already gotten an R&D tax credit, and some of you may not. So I'm going to talk to everyone, and hopefully everyone can learn from this. So the R&D tax credit has been around since the 1980s, and it was originally put in by Congress when technology, the tech world, was new. And also foreign business was new. It used to be US manufacturing dominated the business world, right? And now we get into the tech world, and we got a lot of companies in Japan and other countries, and the US wanted to stay competitive as in this new tech world. So they put in place an incentive for companies who are involved in research or experimental expenditures, trying to develop something new for their business, that they can get a tax credit. Now, a tax credit is different than a tax deduction. A tax deduction reduces your taxable income that you're taxed on. A tax credit reduces your actual tax dollar for dollar. And the R&D tax credit is a complicated calculation. We're not going to get into the specific mechanics of how it's actually calculated, but I will hit on what drives that credit. First of all, it has to be related to a trade or business. Second of all, has to be undertaken for the purpose of discovering information that's technological in nature. And this is where we get back to the 1980s when this first started. That was the purpose of the tax credit. Since the 1980s, everything has gotten technological. So a lot more businesses qualify for this credit, including the dental world. In the last 10 years, or even that long ago, talking about the R&D tax credit in the dental space was not common. And now that there's been a lot more momentum we do see a lot more opportunities in the dental space for R&D tax credit, and I'm going to get into some specifics there. But this slide is a 4-part test of the drivers of the research credit. So it has to be in connection with the trade of practice. It has to be for the purpose of discovering information that's technological in nature, and it has to be useful in the development of something new or improved for your business. And that's important to note, that it's for your business. It doesn't have to be necessarily something new to the world. You don't have to be a breakthrough dentist who's invented a totally new procedure to qualify for this tax credit, but it does have to be something new or improved for your business. And that's another thing that's changed in the dental world in the last several years. I wasn't around in the 50s and 60s, but I imagine for your parents or grandparents that may have been dentists and they were starting out back then, most of the dental world when they got out of dental school was not that much different from when they retired. And I would venture to say that that is completely flipped now. There is so much movement, so much change, and it's happening at an accelerated rate that a lot more dentists qualify for developing something new or improved. And lastly, it has to have elements of that constitute a process of experimentation. So some form of trial and error. So where we see this in the dental world, we see new procedures, new types of procedures, new equipment that's being experimented on. You have to spend some time learning how to use that CEREC or whatever the new equipment might be. New processes that are making your process with patients more efficient. Adding an in-house lab, something like that. New materials that might make orthodontia care more durable or a faster process. All those kinds of things are general areas where dentists can qualify for the R&D tax credit. Now, the main drivers of the calculation are wages. Wages is the big one, and that includes owner wages. So this is where it's actually to your benefit to have a higher W-2 wage if you're involved in a lot of research type activities. Supply costs, supplies that are directly related to whatever research project that you're claiming, and payments to contractors. Now, payments to contractors do take a haircut. Only 65% of that expense is allowed into the calculation. And I think that Congress is just trying to incentivize people to pay wages, right? They want their Social Security, they want their Medicare, and they don't want disputes over, I should have been classified as an employee, things like that. And they're trying to get more people covered with benefits and things like that. So I think that's the incentive behind that. But nevertheless, that is a rule that 65% of contractor payments related to research factor into that calculation. And computer leasing, we don't see a ton, but if you're renting a computer to do the research or utilizing some web hosting, things like that, then that may come into play. Now, in addition to the federal tax credit, a lot of states, and as you can see from this map, probably most of the states offer some form of tax credit related to R&D. And that's commonly overlooked, surprisingly enough. So I mentioned that I was an auditor for the state of Utah. Utah has one of the most generous R&D tax credits. There's actually 2 parts. There's one that goes into the same complex calculation that the federal credit does, and then you get an additional 7.5% of your research expenses on top of that. And when I was an auditor, and on the dark side, we were trying to get people to pay more taxes back then. Once we see a claim for the R&D tax credit, it was basically all over. There was nothing we could do at that point, because usually the R&D tax credit wiped out whatever other issues there may be on the tax return. And a lot of times we saw that credit be underclaimed. They only claimed one part of it instead of both parts. So be aware of that. California has an interesting tax credit where there's a tax credit calculated on the business level and another one calculated at the individual level. So it's separated a little bit. But you want to make sure that you are, if you're claiming the federal R&D tax credit and you're in one of these states that has a tax credit, you want to take advantage of that. And we've seen reports provided to us from R&D specialists where they've calculated the federal credit and they have either missed or undercalculated the state tax credit. And we've had to step in and ramp that up. So is there anything you need to be cautious about with regards to the R&D tax credit? There are a few pitfalls that you do need to be aware of. First of all, the technical rule is once the new component is being used on paying patients or customers, it's no longer considered research. So what counts is the time that you're spending after hours or between appointments. I had a client that brought in family members on the weekend to try things out with. That all qualifies. Now, like I said, there's usually an exception to the exception. So you're not allowed to claim the research tax credit for research that's already put into service and you're getting paid on. But if you're improving that process, then it's still research at that point. So that's the sticking point. But just be aware that there are some technicalities here. And all research is required to be amortized over a 5-year period, meaning if we identify 100,000 just as a round number as research expenses, that 100,000, even though you may get a tax credit for it, it has to be capitalized and spread out over a 5-year period. You can't just expense that all in year one, which can be a little bit of a bummer because you might get a tax credit, but the adjustment to your taxable income may offset the benefit of that tax credit. Now, over a 5-year period, you're still going to win because you're going to get your expenses and your tax credit. But in that first year, it may be a little bit of a sticker shock where you're expecting a tax credit, but you could even end up owing more tax. Now, there is a bill in Congress right now. The House has actually passed it to remove this rule. And the Senate, it's going to the Senate. The Senate has informally agreed to pass that. So this is likely to change. But that is the rule for now, and I'm just making you aware of that. But likely this little bummer part of it is going away. So that's good news. And you do want to be cautious about overly aggressive promoters. So most R&D specialist firms, they might charge 30 to 35% of the credit to calculate it. And they may be doing a good job and getting you a good tax credit, but they're incentivized by that 30 to 35%. And you just want to make sure whatever they're claiming is reasonable, it's defensible, and you're not going to jail and you're not going to end up paying more in taxes and penalties because of them being overly aggressive. So be careful of that, about that shiny fool's gold there. But and I've had some people that I talked to in the industry that are overly conservative. I had one person tell me that, hey, don't get caught up in the R&D tax credit bandwagon for dentists. Dental is a known world, known industry, and no dentist can really legitimately qualify for the R&D tax credit. And I had to respectfully disagree because dentists are constantly involved in trial and error and making improvements to their practice. And it's all technologically related. It's all utilizing technology. Now, on the flip side, I do think some promoters are being overly aggressive. So our approach is we want to get our clients everything that they qualify for, but we don't want to be dishonest or break the law in order to make a number look good that's going to get the client in more trouble down the road. So how can Smiles at Sea, a Smiles at Sea cruise produce an R&D tax credit? Well, there may be a course that specifically relates to a research project, meaning something you're trying to implement in your practice. Often there are courses that talk about that. And if you're still involved in the trial and error of implementing that new equipment or that new procedure or the like, and you go to a course, that potentially could qualify as some of your time that you're allocating toward the qualifying research. Wages, again, the main driver of the R&D tax credit is the wages. The more employees that are involved in the research, the better. And so if you send your staff to a Smiles at Sea event and they go to a course that is specifically related to that research, the bigger credit you can potentially qualify for. And again, your wages count in that as well. So even if you keep your wages high or even boost your wages up while you're doing research, that may be to your advantage in terms of the R&D tax credit. And let's see. Oh yeah, okay. So this is a summary so as a recap, the CE events are entirely tax deductible. Business travel is entirely tax deductible. Cruises for non-owner and not highly compensated employees are tax deductible. And there's a possible enhancement of your R&D tax credit by going to these kinds of things. That's basically what I had, and I'm going to open it up for questions at this point.
I think everybody stayed on mute. That was great information.
Okay, well, I know this was a
Here
lot
we
of.
go.
There we go.
Oh,
All right.
yeah, Lou.
Takes me a second to unmute.
Okay.
Technically challenged. So I teach a dentist or an orthodontist, say, who is new to practice, and I teach them how to become a better leader,
Okay.
which for them is brand new.
Yep.
Is this something that can be part of the R&D for them?
Yes. Yeah. I'm saying that generally because it depends
Right,
on
right.
what they're.
I know I'm trying to be as specific as I can. I know there's always nuances, but
Right.
I mean, you just paid for the course right there.
Yeah.
This
Yeah.
course is essentially free for you,
Right.
right?
Yeah. If
Ultimately.
they're learning and they're experimenting and they're trying to implement something new in their practice, then your course is part of that. Their time in your course is part of that R&D tax credit calculation. And like we said, nuances, of course, but that could be a good selling point.
Same thing if I'm teaching them how orthodontists can help with OSA, and that's not part of their normal, it's the same deal.
Yeah.
Teaching them how to use a laser when they haven't used one before.
Yeah.
One after another.
Yep. Yeah, as long as
We're
they're
going to talk
still.
about that some more and
Yeah.
get in the weeds on it. But
Right.
that's a huge selling point for any course and in particular for Smiles at Sea, but for other people doing courses, that's a big deal right there.
Yep.
Okay. Thank you.
Yeah, thank you.
I have a question, Steve.
Yeah.
You can maybe help with this. So what I'm pretty clear on is a tax write-off is not the same as a tax credit, right?
Correct. Yep.
Would you feel that a dentist bringing their team that could be a tax credit if they put it under R&D, or would it just be a dentist bringing themselves? They could put that under R&D. What is the difference between the two?
Okay,
And what's
yeah.
realistic? So a team of 10 comes to the Smiles at Sea cruise to learn how to do lasers, how to learn better leadership from Lou, to learn things that they want to trial and error test on a cruise ship. Can you be kind of clear? There's 10 team members.
Yep.
Let's just say the total of each team member, all in expenses, is say $1,500. 1,500 times 10 is $15,000, and they have 5 days away from their practice. Is of the $15,000, when you're looking at R&D credit specifically, would that qualify not as a write-off but as a tax credit?
Yeah, and I'm glad you brought this up because this is important to clear up. So the $15,000 that is for sending the team to the cruise and to the CE event, that's going to be a write-off, that portion of it. But assuming you're still paying them, they're on the clock, they're on salary, or whatever the case may be, because this is a business trip. The wages that you're paying them is the driver of the R&D tax credit. So that's what qualifies for the R&D tax credit, and the time that you spend at a Smiles at Sea course, or potentially even the travel time as well. That's going to count toward the allocation of wages that's considered research and drive into that R&D tax credit. And the course itself and the cruise, that's going to be a write-off.
Understood. So there's actually the write-off portion, which is the cruise and the event. But then on top of the write-off portion, people can actually pay for their team to go and consider the wages as well a write-off. So really teams can be going back to their dentists and saying, hey, have you heard of a R&D tax credit?
Yeah.
You need to talk to Steve Nance, because he actually can make it to where we're paid to go on this cruise. Now all of a sudden people will be more likely to want to go on a cruise if they're potentially paid to do so. So they are going back and advocating to their dentist.
Yeah.
This is not only a write-off, but you can pay me to go there. Now, what if they send their team and they don't go? Is it still the same situation where their team's going as a write-off, they don't go, and they're sending their team and their team is still getting paid? Does that work as well if they're not present?
Yep, absolutely. Yep.
And we can drop the mic.
Yeah. This is huge. When you think about the implications, this is huge.
Yeah, absolutely. All right, cool. Well, Steve and Michelle, if you could put the link on how to contact Steve in the comments below the chat session, that would be great. So much amazing content. And listen, this is not just good content because some of it was around how do you write off a Smiles at Sea or dental festival. It's really good to get the shortcuts and know it's existing in the industry, because I have heard of the R&D tax credit for a couple of years now, more than ever in the dental industry, and it's real, and no different than EDIL was real for people in the PPP, like all these different things. I think it's awesome that you're offering it. Really quick, and I just want to ask you: is there anything that look? There it is. You're offering a free consultation.
Yeah.
So, you want to just explain that?
Yeah, so I am happy to talk to you as a free consultation. There's a QR code if you want to scan it, and I'll also put my contact information up here as well. I'm happy to talk to you and answer questions. I'm happy to take care of you from a tax planning or tax standpoint. But even if you just have questions, if you want to talk through that, I'm happy to talk to you. So and not charge you for it. So I'd love to talk to you. Just give me a ring.
Awesome. Thank you so much. And Michelle, I believe you put it down in the link below the website to meet with Steve. And anybody has any questions, please reach out. Once again, I'm giving my full endorsement because I have been working with Steve now and for a while, and it has been absolutely amazing, and I would highly recommend it. So thank you so much again, and I hope everybody enjoyed it, and it was very informal for